Hey guys, welcome in this new video. I hope that all of you are doing great. Thank you for coming back on the channel once again. So in this video, what we're going to talk about are the differences between retail traders and institutional traders. And you will see why this can actually help you a lot to improve your results in your trading. So just before that we start, as always guys, don't forget to leave a like under the video. I would really appreciate it. It supports the channel, and make sure as well that you are subscribed if it's not already done. Alright, so first of all, why is it even important to understand these differences? Well, the answer is quite simple. So you have 90% of traders who lose money and only 10% of traders who make money. And so if you look at these 10% of traders, one thing that you will notice is that they all trade in similar ways. Now, of course, this is a generalization. They don't all trade in similar ways, right? But most of them use a very similar analysis process. And the reason why is pretty simple. It's simply that if you can find a process that enables you to trade in a logical way and to find high quality trade ideas, well, of course, you will want to use that for yourself, and you will also want to teach that to your employees, right? So as hedge funds, for example, hire a new trader, right, or a new group of trader, of course, they will want to train them in order for them to trade for the bank or for the hedge fund, right? And through this training, well, they will be taught this analysis process that I'm talking about. And the analysis process in itself is quite simple. So what they do is that they simply follow a top-down approach. So they start with fundamentals, they get their perspective and their view and their direction of the market from their fundamental analysis. And then they use the technical analysis to position themselves on the market and to be able to time their idea. It's of course a bit simplified the way that I explained it, but it's actually what they do. And so that is one of the biggest, if not the biggest difference between retail traders and institutional traders. And so that's the first point that I wanted to mention in this video. Understanding the real analysis process that you have to go through in order to select good trades. So what most retail traders do is that they simply look at the technical analysis, right? And that in itself is a big problem. And the reason why is because the chart does not predict the future, okay? The chart is simply showing you what happened in the past, right? It's only a reflection of everything that has already happened. So how can you take a trade, right, if all you have is past data, right? You can see that already here there is a flaw in the thinking process, right? So most retail traders, what they do and the mistake that they make is that they think that technical analysis will predict the future. So they will place, trend lines, or they will place a, support resistance, right, different zone, or a Fibonacci or things like that. And they think that with these tools, they are able, to predict the future and to know what will happen in advance. But the problem is that it really does not serve that purpose. As I explained in the real analysis process that professionals go through, technical analysis is only there to time their trading idea that they got to begin with their fundamental analysis, right? So that is one big difference. So instead of starting with technicals like retail traders do, what professionals do is that they start with fundamentals, they get the direction that they want to trade the market from their fundamental analysis, and then they simply go on the charts and try to time this idea the best they can. So that's really, the simplest way I could explain it. So in order for you guys to improve your trading, you need to start looking at fundamentals to get your perspective on the market from this, and then using technicals to position yourself in this direction. It's really, that simple, okay? So if you make just this one big difference in your trading, I'm telling you, everything will make a lot more sense and you can get much better results, because all of a sudden you will trade in a much more logical way. Okay, so that was the first point. Second point that is also really important is that when it comes to these hedge funds and things like that, when you think about it, right, do they only have one trade open or two trades open, right? Of course not. They will have multiple positions open across multiple different markets, simply because they are a hedge fund. They want to protect their capital, but they also want to get growth at the same time. So what they will try to do is limit their downside and maximize their upside potential. And so again, when they use their fundamental analysis, they will get their worldview. So they will get an idea of how markets will evolve, and then they will position themselves based on this idea on different markets because they want to be diversified. They don't want to have all their risk only on currencies or only on the stock market or only on cryptos, for example, right? So of course they will trade multiple different markets, and that makes a lot of sense. But again, this is something that retail traders don't do. Most retail traders only look at, most of the time they look at one or maybe two markets, right? And they will take a very small amount of trades in terms of how many trades they have at the same time open on their account. But since they trade more short term, they actually take more positions. It's just that they take trades, they close trades, and they repeat this so many different times, again based on technical analysis most of the time on short time frames. And again, here you can see a massive difference between the two sides, right? So you have one side that trades short term on technical analysis and focus only on one or two market. Then you have another side who build portfolios, who have a lot of positions that are more medium to long term on different markets. So again, you can see two different worlds, right? And so these are really two big differences. And I would say the third big difference simply comes with risk management. So most retail traders will risk far too much on every single trade that they will take. Sometimes I see people risking 5%, 10% on one trade, and of course that's totally insane. It's way too much because it puts way too much pressure on the account, and if you only get a few losing trades, then you will get yourself in a big drawdown, and it's much harder to come out of a big drawdown. So when it comes to the more professional side of trading, the risk management is well under control, and that means that the amount in terms of percentage that they risk on every single idea that they have is much smaller. And again, what this helps, the reason why it's so important is simply because this enables you to get good and consistent growth over the long term without being impacted by too large drawdowns. So these are really three big differences. Now there are other ones. I could talk about this much more in details, and that's what I do in the course. So if you guys are interested in the course, as always, it's in the description box below. But here I really give you guys the three main differences, and I'm telling you already, right, with these three differences, if you really take the time to think about them and to adjust your trading for it to look more like the professional side of trading, I'm telling you this will make a massive difference in your trading and can really help you improve your results. So I hope you guys enjoyed the video. If you did, as always, don't forget to leave a like on it. If you have any questions as well, you can drop them in the comment section below, and that will be a pleasure for me to answer your question and help you more even in more details. All right, so on that, take care, trade with care, manage your money well, and I will see you in my next video. Bye bye.